Hello, chart watchers, and welcome to this Tuesday, September 25th Market Watchers Live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the market was down a little bit earlier, but we are rebounding. The Dow Jones Industrial Average currently up 30 points. The S&P 500 up 2.5. NASDAQ outperforming on a relative basis, up 17 points. Also, the Russell 2000 bouncing off its lows from yesterday, which was about a 6-week low. We are bouncing today on the small caps, up about 5 3/4 points to 1711. 10-year Treasury yield continuing to move higher, now over 3.1%, getting close to that 3.11% level that we reached in May. Of course, the Fed opens its meeting today. We'll see what happens with rates, but I think it's widely expected we will see another rate increase tomorrow. Volatility back moving lower again today, down about 0.5%, not a lot, but it is retreating from the high seen yesterday. Energy having a strong day today, up testing some overhead resistance, and the exploration and production index leading on a relative basis. Actually, I believe the oil equipment stocks are doing a little bit better, but from a longer term perspective, the exploration and production stocks looking very strong. We'll talk about that in a couple minutes. Utilities taking it on the chin today, moving to the downside. You can see that this moved to the upside in the Treasury yield in September, really having a negative impact on the utilities as they continue to slide. McDonald's and Walt Disney both having strong days today to lead the Dow. To the downside, though, Intel getting a downgrade. Aaron will take a look at that in a bit. But with that, Aaron, market overall continuing to hang in pretty well. Got the some of the cannabis stocks back in the news. We'll talk about that in a couple minutes. But how are you doing this Tuesday?
I'm doing quite well this Tuesday morning here in Southern Cal. I have this really weird stuff in my sky, though. It looks kind of white and puffy, and
wow.
I know. I'm not sure. I think the sun is kind of hiding. So
cotton balls. Cotton balls.
Exactly. So yeah, great morning. Hey, I was interested in seeing that energy's doing so well today. We just Decision Point just got a intermediate term trend model buy signal on it yesterday, and that effectively puts all of the sectors as far as DP analysis on buy signals in the intermediate and long term. So how can you argue with a market where you have all of the sectors on buy signals?
You can't.
Exactly.
That's like arguing with a freight train jumping out on the tracks. I mean, it'll just run you over. That's really the hallmark of a bull market, is wide participation. Obviously there's some areas of the market that outperform others, but you want everything going up where there isn't a whole lot of technical weakness to go around, and that seems to be what we have right now.
Yep, absolutely. Well, looking at our schedule coming up, Tom McClellan is going to be in with us tomorrow. And on Thursday, Dan Russo from Chaikin Analytics will be joining us as a guest. And then Mary Ellen McConigal will be back on Friday to discuss which stocks are hot and which ones are not. So you'll want to stay tuned through the rest of the week here. Today, Tom, you got a workshop. It'll be interesting to see your seasonality. And then 10 and 10 to 1, we have Arista Networks. That will be our first symbol if you want to go take a look at it. And finally, I will round out the show with correlation. I'll be talking primarily about the dollar and gold. And with that, as we say, let's go ahead and get started with those technical headlines. I know you just had a ton of economic reports come out today.
Yeah, there's a number of economic reports out. Of course, it all started today with the FOMC meeting. We do have the meeting that started today, and we'll go through to tomorrow. And then, of course, we'll get that update on what the Fed is doing with interest rates. But earlier today, we did have the July Case-Shiller home price index out. And that came in about as expected. I think we have a slide we're going to pull up here in 1 second that you can take a look at. Hoping to get it up here.
I'm sure they're busy in the background trying to get it there. Here we go.
Okay. We got July Case-Shiller home price index. You can see went up 0.1%, was exactly what the market was expecting. And then we had the FHFA House Price Index also coming in this morning. This one rose 0.2% versus the 0.3% that was expected. And then finally, September consumer confidence came out at 10 a.m. this morning. 138.4 was the actual number. Market only expecting 131.7. So I thought all of that combined was pretty good news. I mean, I know the home price and home building stocks in general have been a little bit weak, but I think overall the market's been strong, and I think that consumer confidence number kind of speaks to that as well. Here you can take a look at the 10-year Treasury yield. We have been in a steady uptrend that we've been talking about for some time. We are battling overhead resistance, and I would suggest that we respect that resistance. If you go back just a year and a half ago or so, you can take a look at a very similar kind of a situation where we ran up. We got up to about maybe 2.62%, pulled back for a little bit, consolidated, went back to 2.62%, couldn't get through, and we ended up moving back lower. So you take a look at what we're going through now, and it looks very similar. We made the move up, got to 3.11%. Here's that consolidation, very similar to what we saw maybe over a shorter time frame back at the beginning of 2017. But still, we've got that sideways consolidation, the move back up, testing overhead resistance. I'm not expecting that the 10-year Treasury yield is going to drop like it did back in 2017, but I think we have to be prepared technically for this to represent that overhead yield resistance until we get through. I think we're going to go through. I think here we've got a PPO that's looking incredibly strong to the upside. I think the 10-year Treasury yield breaks above that 3.11% and signals additional rotation away from the defensive Treasury market into the more aggressive equity market. And of course, that means good things if you're on the bullish side for equities. I believe the market goes higher. And not only do we see new money coming into the market in the fourth quarter, which is typical, but I think we're going to see rotation out of the bond market and into the stock market. So I think that the fourth quarter 2018 is shaping up to be a really good one. And I think it gets back a little bit to that point you made earlier, Erin, where I know Decision Point is looking at all these sectors, and it's a mechanical formula. But I think, for those that are trend followers, it makes a lot of sense. All of the sectors on buy signals, all the major indices on buy signals, and the market looks pretty good here. Let's take a look at a couple of areas of the market. We mentioned the energy group leading today. And yes, we are definitely moving higher, PPO strengthening. But like the 10-year Treasury yield, I think it's really important to keep in mind the overhead areas of resistance. And that's where perhaps we might see a little selling in this 77, 78 area. Because as we move back up, this has been where the sellers have kicked in the past. We could go back to January where the high was 77, May where we never closed above 78, and then twice in July we got above 77 and couldn't get through. So 77 to 78 clearly has been resistance in 2018. So yes, we're on a nice move to the upside with energy, but we've seen this before. This isn't a new story. This is one that we've been dealing with throughout 2018. So the question is whether or not energy can break out and make a move to the upside. The problem historically, when we take a look at the seasonality, I think what we'll see is that energy is not one of the better performing groups in the fourth quarter. I'm going to talk about this a little bit more in my workshop. But when you go back over the last 20 years, you take a look, December's not a bad month, October and November. And the best way to take a look at this, by the way, is comparing it to the S&P 500, because at least from my perspective, I want to try to outperform the S&P 500. If I can't do that, I could just put my money in the spider and go play golf. But here you can see October is not a particularly good month going over the last 20 years in terms of energy, as the XLE is underperformed on average by 1% in October and by 0.4% in November, and only picks up as we get into December. So we are heading into not a bad month. Again, if we take a look at this and ignore the S&P 500, if we just pull this up for the XLE, you'll see that the returns are positive. It's not that on an absolute basis, energy doesn't typically go higher. It's on a relative basis. So energy goes higher in October and November, but if we take a look at the SPX, remember October and November were both 0.8% gains, but look at the S&P, 1.8 and 1.1%. So that's where the relative weakness comes in. It's not that it's bad, it's just that it doesn't keep up with the S&P historically. And if you're trying to outperform the S&P, it makes it difficult if you're trading a group that's underperforming. All right, so what's leading energy today and what are the prospects here? Well, earlier, the DJUSOI, which is the Oil Equipment and Services Index, was leading, and here's the push to the upside. Nice move up 1.44%, clearly one of the leading areas in the market today. Looks like it could be breaking this downtrend line. Looks like maybe it already has. The 20-day moving average is turning up, so if this truly is in an uptrend, I would watch that 20-day moving average to the downside, and let's see if we get that continued movement up in the PPO and clear that center line resistance, because an uptrending market is one that normally has, well, will have a PPO above the zero line, whereas a downtrending market is going to have a PPO or feature a PPO that's in negative territory. So we are about to make that cross. I think that's significant. I think the PPO center line is a significant indicator. And so if we break the downtrend, get back up above the moving averages, PPO crosses center line, I think the DJUSOI looks pretty good. But, and I'm going to stretch this out a little bit so you can kind of get a feel really for what's been taking place over the last couple years. Here you can see that the high was established back almost 2 years ago on the Oil Equipment Services Index, where we reached a high up about 550, 555. We're currently at 413. So you can see a pretty significant drop. Now let's take a look at the DJUSOS, which are the production and exploration stocks. And you see a different picture here, one that's much more bullish in my view. We're clearly above the highs that we saw back in 2016, 2017, and off of an uptrend. We've been sideways consolidating for a while, which I think is a very bullish pattern. So if you're looking within energy and you're looking for individual stocks maybe to outperform, I prefer exploration and production, even though we are seeing improvement in that DJUSOI that I just showed a minute ago. Okay, I did want to mention just a couple of individual stocks. I know Erin's got a number of upgrades and downgrades, so we want to get into that. But let me just take a look at TNDM. You wonder why stocks, why we follow technical analysis? TNDM, Tandem, just came out and raised their guidance for not only Q3, but also for the year. And if you take a look, this stock has been in a major uptrend for a long time. And if I add the scooter here, which I'll do, I think you're going to see that this is a company that has been very high on the scooter for quite some time. Let's just make this a little bigger so that you can see the strength here going across. But check out the scooter, which is at 99.9 and has been staying there for quite some time. So if you're a fan of technical analysis, I think it's pretty clear that the market has been telling us for a long time that this is a great stock. Shouldn't be surprised when they come out and raise guidance. Okay, so let's move on. We got upgrades, downgrades. Erin, what do some of them? I know we had a downgrade in Intel, but what do some of the others look like?
All right, well, let's take a peek. We have 4 upgrades and 4 downgrades, so let me get through those as quickly as I can. So I'm going to start with the downgrades. Let's go ahead and start with Intel since we've been talking about it. All righty. It's not a really good chart. I mean, we've had some issues here, obviously. I'm looking at this big rounded top, really, that you could pull up on the weekly chart. There we go. Oh, and let me tell you who downgraded it and what. Raymond James downgraded it from a market perform to an underperform. And, you know, really, this is almost a V top when you look at it on the weekly chart. But you can see very important support here, I would say, right around that $41, $42 area. And with the downgrade, and look at this, the momentum on the weekly chart. PMO sell signal, it is getting into near-term oversold territory, but we know by just looking at history, we can get much lower on that PMO. So definitely not a good-looking chart right now. And let's go back to the daily version we were just looking at. Here we go. And here's one of the big problems I have today on this downgrade is the fact that we have this support resistance line. Look at how many times this line has been tapped all over the place here. And it didn't hold mid-September. And we tried to rally back out and hold that support, and today we are failing. So it looks like right now we could end up closing on that area of support, But in any case, we're breaking down from it a second time. I would expect to see it fall down to that $42, or as I was saying, that $41 to $42 area where we had the last bit of support. You can see right here on the gap as well. All right, so that was the first downgrade. Let's go ahead and look at some of the other ones. CACI, Jeffries moved this one from a buy to a hold. Another one where you can see that rounded top. It's now come and is testing very important support. You have a PMO sell signal, and it's still looking like it's negative. You know, we're not getting acceleration on this PMO, but it is still in decline. We haven't hit negative territory yet. I would see that you can see this one dropping further. Watch this area of support. If we lose that area of support, likely a move down to that 170 area right here where we have the secondary area of support. Next downgrade, Cypress Semiconductors. KeyBank downgraded this from overweight to a sector weight. So moving into sort of a neutral position. I called this one up on the weekly chart because the daily chart was just a mess of choppiness. You can see right here from the past year. It's been in a trading zone that's, you know, I mean, if you got in at the bottom of it and you can ride it to the top, it's been fairly lucrative. But right now, it's testing the bottom of this area of support. Now, I believe that this is a good spot if you wanted to try and get in there to bottom fish, but I would have a really tight stop here. Because, and I only say that this could be a candidate because it is at the bottom of a trading range that has been in effect for nearly, I would say, a year. It looks like we've had it going for about a year. So we're at the bottom of that range, and we could see it make its way back up to the top. But we are looking at a downgrade here, so you know, keep that in mind as well. But I think we're really at critical support here. And if it can hold it and start it making its way back up, I think that could be a nice move to test the top of that trading range. Right now, not looking too healthy, though. All right, final downgrade on ON Semiconductor. And here's another one where you have that big rounded top. I wanted to point it out on the daily chart. You've got a top below the signal line for the PMO, and look at the drop here and trading below. Very important support that you have back here from December, and really that was also formed when you look at that low we had previously in September. It actually dipped further below that. But I wanted to show you that big rounded top so I can show you the weekly chart, and let's get a peek at it there. So you can see that giant rounded top we're looking at for 2018. We've broken down, you can see all these little areas of intermediary support that were broken all the way down the line. And we're now breaking that important support back there from late 2017. I would look for a move at least to this area of support right here at that top that we had back in the second quarter of 2017, and that's at about $17. But you know, if you lose this area of support where we're at right now, you know, there's still plenty of downside opportunity here. Clorox upgraded. Argus from a hold to a buy, looking pretty good as far as the trend going on price. I wanted to annotate that. At first my eyes were saying, oh, we might have a rising wedge there, but no, actually it's a rising trend channel. Not liking, of course, the PMO configuration here. I would like to see, excuse me, I'd like to see this PMO start to at least decelerate, but we are in a near-term area of oversold if you want to look at that previous low we had at the beginning of September, but we're still really fluctuating here in overbought territory. But remember, this was an upgrade, so we could certainly see it climb higher and get ready to come back up and test the top of that rising trend channel. This one I thought looked great, HP, Helmerich, and Payne. And I like this one very much on this upgrade. You could make a case here for a reverse head and shoulders. You've got the breakout above this area of overhead resistance that's been in place since July. And now there's a lot of upside opportunity just to come up and test resistance. There's a good chance it could pop up above that resistance level. But I think with the upgrade, the PMO buy signal lining up, the breakout above that area of resistance, and this reverse head and shoulders, I think that HP looks pretty good. SAIC Jeffries moved from a hold to a buy. And as you can see, we have a gap up right now after this big drop that we got likely on earnings, I would guess. And now we've got a big move here, a gap up, and the PMO is turning up. I feel like the, oh, that's not a negative divergence. I needed to put that over here, but I think that that divergence was worked out from this top to this top, declining tops, rising tops. I feel that that was worked out, of course, through that drop that we saw earlier. And now, like I said, we popped up. This is, you can see how important this area of support resistance is. So we got the gap up. I'm looking at it as a breakaway gap. I think it looks great. And finally, we're going to look at Workiva. This was upgraded by Robert Baird from a neutral to an outperform. Another one with a big gap up. That is now turning the PMO around. It was not turning around on this rally upwards. So I'd be a little bit suspect of this. Could very well end up being, though, a breakaway gap here rather than an island based on the fact we're getting the upgrade. That's all I've got. Sorry, I took a little extra time there from you, but are you about ready for your workshop?
I am kind of excited to do this one. This is a little combination, little combo pack today. I've talked a lot about seasonality. And of course, I will be talking about seasonality later as far as October goes. But I thought what I would do today is combine the seasonality for the fourth quarter of this year with drilling down, which is a segment that we have done before, where once we find something we like, we try to figure out, okay, well, what's the, how do we go from here to come up with something that's tradable? So that's where we're going to start. So I'm going to go ahead first. I want to just show you it was a blog article I did a couple years ago. This was back on January 7th, 2017, so it certainly could use an update. But I have a chart here of all the different groups, all the different key sectors, and how they perform relative to the S&P 500. And I put them in a chart here by calendar month. So for instance, technology, XLK, in the month of January, averages outperforming the S&P 500 by 1.2%. So the first thing you need to know from this chart is that these numbers represent the relative performance, the relative outperformance or the relative underperformance versus the S&P 500 by month. So this doesn't tell us that the XLK average is going up 1.2% in January. It tells us that it is averaging outperforming the S&P 500 by 1.2% during the month of January. And so you get these relative performance numbers going across here during each month. And what I want you to kind of focus on is when you get into the fourth quarter, October, November, and December, you can see, first of all, the technology, if you go across the 3 months, yes, December's a little weak, but you outperform the S&P by a pretty wide margin in October, a little bit more modest amount in October. You take a look at consumer discretionary, which is the next line item, the XLY, and you've got pretty solid outperformance in all 3 months of the quarter. Industrials lag a little bit in October, but then very heavy outperformance in November. And again, another solid outperforming month in December. And then financials really the only one of the 4 aggressive sectors that tend to just kind of go along for the ride with the S&P, maybe slight underperformance in the 3 months in total. Although I think this year could be different if we get a breakout in that 10-year Treasury yield. Financials tend to do much better in that kind of an environment. We really haven't been in a rising interest rate environment for an extended period of time in many, many years. Of course, we've been trending lower in the 10-year Treasury yield for probably 35 years up until just last year when we started to turn back to the upside. So I think financials may join the party this year. We'll have to wait and see. But I wanted to focus on the fact that technology and consumer discretionary and industrials tend to outperform in the fourth quarter. And the other one I wanted to look at was materials. If you check out materials, after underperforming 4 of the 5 months heading into October to December, we get very strong outperformance in materials. heading into the fourth quarter. So I think that's worth noting. So the first thing I just wanted you to kind of focus in on is that the key areas, the key sectors that outperform or tend to outperform, and it's just tendency, it's not a guarantee. That's really important to recognize. It's still going to depend on what the technicals are telling us, but just be aware that there are sectors that tend to outperform the S&P 500 in the fourth quarter. And this is going back over the last 2 decades in coming up with these numbers. So let's take a look first, and I'm going to show you how you can do this on stock charts. Let's first go back to the member dashboard here. And if you pull up seasonality, the one that looked the best to me, just looking at that chart, was materials for the fourth quarter. So let's look at the seasonality for XLB. Now, this is 5 years. That's the default. But if you drag this little slider over 20 years, that gives us last 2 decades. Look at the October, November, and December average performance on the XLB. As compared, we've been talking about, at least I've been talking about, how the XLB really hasn't had much direction over the summer, and through most of the summer was the worst performing sector. That kind of goes along with history. History, you know, this is not a good group during the summer, but it tends to switch that, turn that light switch on as we go into the fourth quarter. And I think these numbers kind of bear that out. The other way to look at this is to compare the XLB to the S&P 500. And again, you'll get a 5-year default chart, but then you drag it out to 20 and look at the outperformance. This is what we were just talking about. Now, the numbers I just showed you on that chart, remember, were from 2 years ago. So this is getting the current numbers. But you can see, looking across here, that materials, relative to the S&P, materials have outperformed by 3.7%. If we add up these 3 numbers for these 3 months, we've averaged outperforming by 3.7% in the months of October, November, and December over the last 20 years. So this is a group, from a seasonality perspective, we need to find out what's going on with materials and what's leading the materials. Now, the other groups that I wanted to focus on, the XLY, if we pull this up relative to the S&P 500, get the current numbers instead of that chart from 2 years ago, you'll see that the numbers are still pretty close. But each of the 3 months, we tend to outperform. Consumer discretionary tends to do very well in the last 3 months of the calendar year. And then let's pull up the industrials. Within the industrials, you can see that over the last 20 years, slight underperformance in October, but heavy outperformance. Look at November, 84% of the months, or 84% of Novembers since the turn of the century, we've seen industrials outperform the S&P 500. So we should probably be thinking about, over the next few weeks, considering building maybe a little bit of an overweighting of industrial stocks. Certainly not. I wouldn't be afraid to trade industrials based on seasonality, especially if the technical conditions line up. If they, if you start to see stocks within the industrials, within some of the industry groups within industrials that are showing technical breakouts, and you look and you see that they tend to perform well in the fourth quarter, I think the seasonality bias adds to the technical bias. If you're already bullish from a technical perspective, and then you look and you see that seasonal, or from a seasonal perspective, a particular stock or industry group tends to do well during the fourth quarter, then I think that adds to the confidence that you should have heading into a particular trade. So here you can see industrials clearly outperform. Now, I'm not going to get into technology. We've talked a lot about technology, and I'll be honest, the biggest area within technology in terms of fourth quarter outperformance is internet. And I don't like the current technical state of the internet stocks. That could change, but for now, I don't like it. So I'm not going to spend a whole lot of time talking about it, but you can see that the XLK performs very well, especially in October and November. December kind of tails off a little bit, but tends to do pretty well in the fourth quarter. All right, so now we've kind of got this framework. We want to look at the materials, we want to look at the consumer discretionary, and we want to look at the industrials to find areas of the market. Let's keep drilling down to find within the sectors what industry groups make sense. Now, check some of these out. First, we've got steel. And I'm going to look at the steel versus the XLB. Could do it versus the S&P 500. But let's go ahead and pull it up versus. Actually, before I even do this, let's get rid of the Excel. Let's just show you the seasonality of the steel stocks over the last 19 years. Look at October, November, and December. Pretty impressive performance. You're looking at August and September, which were absolutely horrible. June was not good. July and June just kind of offset. So we're coming through out of 4 months where we tend to see weakness in steel stocks. And from a technical perspective, and I'll come back to this chart, seasonal chart here in just a second, but if we take a look at what's been going on the last 4 months, this is what we would expect based on the seasonal chart. We tend to see steel struggle, but it's like flipping that switch. And when you get into the fourth quarter, look at these average returns, and you can see that it's not 100%. We don't go up every October. Steel doesn't go up every October, November, and December, but about 2/3 of the time it goes up, and you can see the average returns for the months. So steel is going to be an area that I'm very interested in. If we look now, that was the one that really stood out to me in terms of the materials. Now, there are several on the consumer discretionary, but I'm going to highlight the big ones. I want to take a look at the home construction. And we've talked about this one before. But here is your home construction. First, let's just pull up home construction. Then we'll show it relative to the XLY. Last 19 years, look at October, November, and December. It gets better and better as the year goes on into the end of the year. And I know home construction has not been a good area to be invested in 2018. We topped back in January, rolled over, lost a lot of key moving averages. We've been trending lower for many, many months. But home construction, I think, it's got a pretty good support at about 525. And if we pull this up on the chart and go to a weekly chart, I think you'll maybe see what I'm talking about here. But we had a huge run in September, starting in September through January, where we went up almost 50% in about 4 months. That's a huge move in one industry group like this. And that move came on a breakout after consolidating for about 8 weeks, came on a breakout above about 725. And if you notice this downtrend, we're getting close to the 725 area. So if we actually do find a bottom here, just keep in mind, seasonally, home construction lines up rather bullishly. So this is something that technically I'm not ready to jump in, but seasonally I want to be aware that if this group starts to show strength, know that you're backed up by seasonal strength as we head into the end of the year. This is one of the best groups in the consumer discretionary area, which is pretty amazing when you consider the just the fact that I would have suspected, without looking at seasonality, that maybe April or May would be great months for home builders. And March and April are actually not bad. And then we get into May and June, and it really historically tends to take a turn down. But I would not have been thinking November and December would be great months for home construction. Look at January. Really, November, December, and January are the best 3 consecutive months. So let's keep that in mind, at least. Again, this isn't a group that I would be jumping into right now. The technical conditions don't suggest it. But just keep in mind that we do have a really strong consumer discretionary group. And if the home construction starts to show better or show some technical improvement, we could see money rotating within consumer discretionary and beginning to fuel an end-of-the-year rise in home construction. But here is that outperformance I was talking about. October, not so much. But look at November and then December, the outperformance of home construction relative to the XLY. All right, what else? Well, as you might imagine, if home construction does well, probably home improvements does pretty well as well. And over the last 15 years, again, October's a little weaker, but look at November and December, outperformance in home improvement stocks. And then finally, let's take a look at the industrials. Those were the 2 best, by the way, and these are the 2 that I'm going to focus on. But let's take a look at, and by the way, a couple of others, I'll just throw these out there. The DJUSPC, which is the waste. Or no, that's in the industrial. Sorry, which one did I have here? Oh, footwear. Footwear's been very strong. And by the way, Nike reports after the bell tonight. But if we take a look at this on a relative basis, footwear versus the XLY has been up almost 2% above average October through December. You can see September historically is a very strong month, and it has been strong again this year. But we continue to get outperformance throughout the fourth quarter. It's just not as much as we see in home construction. So this is a group that we want to be aware of, that it continues to perform well, but not so much in terms of or on a relative basis to the home construction stocks. One other group I wanted to mention, though, in the consumer discretionary before I move on to industrials, you can see that the business training and employment agencies really taking on the chin here in September. Now let's take a look at this group from a seasonal perspective. It's not that this is a group that goes crazy. I mean, it does pretty well in the fourth quarter, but, and I'm going to show you on its own absolute chart. You can see October, it outperforms consumer discretionary by 2.3%. November, it's a little down, and in December, up 1.6%. But what I wanted to point out about this chart, which a seasonal chart anyway, what that I thought was really interesting is that over the last 15 years, if you added up January through September average monthly returns coming across here, you would get plus 1.3%. So if you're in these stocks over the last 15 years, the first 9 months of the year, you've averaged gaining about 1.3%. Look at what happens in the fourth quarter. It's not that this group is wildly better than all the other groups, but something just hits, and this group comes to life in the fourth quarter, averaging 7% per year over the last 15 years in the fourth quarter. So this is another group maybe to keep on your radar, because September has been very weak, as I just showed you on the chart. But if we start to see some strength in the group, keep in mind that most of their gains, the group's gains, are earned in the fourth quarter. Okay, let's move on to the industrials, because I do still want to get into some individual stocks. So let's take a look first at the DJ. Let's look at DJUSAR. And this is airlines, and what a seasonal chart. You can see the last 19 years, I'm not making this up, just about every year, 89% of October's moves higher for airlines. And the group average is going up 6.8% in October, 4.6% in November, 2.5% in December. And when we look across at the average monthly gains, all the months, October's the best month, November's the second best, December's the third best. We got them lined up right here. And when we look at the chart, this is a group I've been talking about quite a bit. It's been looking very good on its chart from a technical perspective, moving higher, but negative divergence. So maybe we're going to break down and get a 50-day test. But if we get back down to around 280, we got close today, down 282. I think this is a group to maybe begin to look at very, very closely. And we'll talk about a couple of individual stocks here in this space in just a couple minutes. But airlines have clearly one of the best seasonal patterns in the fourth quarter of the year. And I think this is worth keeping an eye on and perhaps investing in the space. The other one that's very interesting in the industrials is the commercial vehicles and trucks index. I think we spoke about this one recently. I forget, we were talking about Caterpillar and Deere. I think it may have been when Mary Ellen was on last week. We went over what's hot, what's not. But anyway, here you can see the fourth quarter. Look at November. Over the last 19 years, this group's gone up 89% in November. And look at these average returns coming across here, October, November, and December. The group average is going up more than 10% in the fourth quarter. And you can see that it's fairly, it's not a guarantee, but there's a lot of bias here to the upside in the commercial vehicles and trucks area. And we'll take a look at some of those individual stocks as well. So those are the 5 industry groups. As we take a look at individual stocks, those are the 5 industry groups that I want to focus on: steel, home construction, home improvements, airlines, and commercial vehicles and trucks. So how do we do that? Well, let's just go back to the member dashboard, and let's go into sector summary. Actually, let's go into the industry summary, and let's start with steel. which is going to be down under the materials. Here we go. And by the way, steel is up. It's leading today. Maybe we're getting a little, I don't know, maybe a little pre-fourth quarter action. Who knows? But anyway, steel. So what I want to do now is I want to click on steel and bring up individual stocks within this group. And then what I want to do is click on the scooter rank, because now I can find out technically which stocks within the steel group are looking good in terms of their technical. So here you've got Cliffs Natural Resources. I know this stock's been on my strong earnings chart list. So obviously it's going to carry a little bit more weight. It's also one of the highest scooter rank stocks. It's a small cap, which I also like because I do think the dollar bounces higher in the fourth quarter. So there's a lot I like about the stock. So let's take a look at the seasonal. And if we drag this back over the last 20 years, October, it averages going up about 1%. But look at November and December, 6.2%, 4%. That, if you add it across there, is 11% on average that CLF gains in the fourth quarter over the last 20 years. So not only do we have a stock within an industry group that does well, this stock also does well. And when we pull up the chart, breaking out to new highs. I mean, it couldn't look much better on a technical basis as we head into the fourth quarter. So would I jump in now with an RSI at 77? No. But this is one that's going to, if I pull back and hit a technical support level like the rising 20-day moving average, not only am I going to feel good about it being on my strong earnings chart list and hitting a key technical level, but I'm also going to feel good because seasonality favors the stock as we head into the fourth quarter. So CLF is one that I would definitely be interested in. Let's go back and look at some of these other stocks. I believe this stock didn't have a whole lot of trading volume. Yeah, very little trading volume. It's traded 2,000 shares today. So I passed on that one. I did look at VALE, and pulled up the seasonality on this one. And going back the last 17 years, it also averages 10% in October, November, and December when you add them together. And then the last one that I wanted to look at in the steel space is CRS. All three of these I'm telling you about, by the way, these are all stocks that have scooter scores above 70. October only averages about 1%, but look at November and December, very strong. So if I'm looking at the stock and I'm in September, I'm in October, I mean, look at this pattern. Got a beautiful pattern. You got equal highs, you got rising lows, off of an uptrend. We got a bullish ascending triangle here. Any kind of weakness back down to, say, you know, the trend line, which is maybe around 57 or so, would be maybe worth considering, knowing that the group does very well in the fourth quarter and that this stock also does very well in the fourth quarter because we have a bullish technical pattern here. A breakout above 61, if you go down to the low, the high of the pattern down to the low, it's $10. Breakout above 61 measures to 71. That's $12 above where we are right now, which is about 20%. And we know historically the stock does 10% on average over the last quarter. So CRS is one I definitely would keep in mind as well. Moving on, home construction. I'm not going to go back and go through every one of these scooter ranks and show you. All I do is I pull up home construction, I sort it by scooter rank, and then I start looking for our highest ones. But keep in mind, this group's been very weak. So there really haven't been any. But KB Homes reports its earnings, I think might be tomorrow. But just keep in mind that November and December tend to be extremely good months for KB Homes. And then DHI, this is a little bit more of a solid home construction company, a bigger company. And if you look at the last 20 years, October, not great, but look at November and December. Keep this one on your radar. If home construction picks up later in the year and we break out of that downtrend, I think DHI is one I would definitely keep on my radar. And then finally, HOV. If we drag this back on HOV over the last 20 years, October 1.6% on average, November 2.6%, December 9.6%. It only goes up half the time, but it goes up almost 10% a year on average. Just seemed like this was one maybe to keep an eye on as well. It's a smaller home builder as well. And then in the home improvement space, One of the top scooters right now in this space is Lowe's, LOW. And when you look, fourth quarter tends to be very strong. The stock averages gaining almost 10% just in the fourth quarter alone over the last 20 years. And what's maybe more important, if you're thinking, okay, well, what about Lowe's versus Home Depot? Lowe's actually, in the month of October and November, is an outperformer versus Home Depot. So I would say when you look at the charts and you see Lowe's continuing to move higher here, breaking out with that heavy volume with its August earnings. Home Depot broke out, but it did so later. I think Lowe's looks like the better candidate as we head into the fourth quarter. One other stock in this space, I think it is RH. Now, there's only 7 years history. Oops, I didn't want to do it versus Home Depot. There's only 7 years history of RH. So take some of this with a grain of salt. But when you look at October and November, it's averaged 22% over the last 7 years just in these 2 months. So when I take a look at the chart, if it lines up technically, I mean, it's getting back close to a key support level. You got gap support comes in at 120, recent lows just below 125. If the stock gets back down into that area, it might be a solid reward to risk candidate, knowing what we know about the stock. And not only its technical outlook, but also its seasonal outlook. All right, the last two areas are in the industrial area. So let's take a look at let's take a look first at the DJUSHR commercial vehicles. And you can see that the group, as I pointed out earlier, very strong in this fourth quarter. So what individual stocks might we consider? This is the strongest scooter in the group, but it only has 7 years of data. So again, keep that in mind. But look at October and November, it averages 10% in those 2 months. GATX, this is a little bit smaller company in this space. And again, this is commercial vehicles and trucks within the industrials. October, so-so, but November, December, the company averages gaining over 8% in those 2 months. So GATX, worth thinking about. Caterpillar, pull up CAT. And you can see Caterpillar going across here, very strong October, November, and December, going up about 9% each quarter. Deere does not have a strong scooter rating. It's not as healthy technically based on the scooter, but look at these numbers going back the last 20 years in the fourth quarter. 10.4, that's 14.2% on average, October through December. So Deere, if you're looking at the chart technically, we get a breakout, I think I'd pay attention because we know what happens in the fourth quarter. So watch that 158 to 160 area. If we get a 20-day test, might be worth taking a shot knowing what this company tends to do in the fourth quarter. And then finally, the airlines. This is the one that if we go back, I'm going to pull this one up using the industry group. And if we go into the industrials and the airlines and we sort it by scooter, you can see a number of stocks that maybe their scooter rank is down because the stocks are just starting to make a move. But I would not let that deter me from getting involved in some of these companies. Take a look at UAL. From a seasonal perspective, the last 13 years, it's averaged going up 11% just in the month of October. And if you go across here, it's over 22%. This stock is averaged going up in the last 13 years during the fourth quarter. That is crazy. Spirit Airlines, SAVE, last 8 years, but look, just in October and November, 16%. The stock average is going up. And then if we take a look, what else? Let's take a look at Delta. That was one other stock that's been doing very well. Just recently got a breakout. Look at October. Goes up 91% of the time. Averages almost 12%. And when you look at the fourth quarter, it averages going up over 20% in the fourth quarter alone. So let's go ahead and wrap up what we talked about. We've got, again, when you combine seasonality with the drilling down I think you can work your way into getting into some really good stocks, especially if you follow the technical, technical and seasonal information that I went over with you today. So I just talked about the sector outperformance, the industry outperformance, and the stock outperformance, and hopefully that'll give you some really good ideas going forward. I do want to mention, if we can pull up the poll, we can maybe go over that right now. But while we're getting that poll up, the whole idea there was I wanted to see how many of you use the seasonality information in your investing and in your trading arsenal, because almost everybody, I think, watching the show tends to use technical analysis. 99%. That if I had seen 42%, then I would have said, okay, we're doing something wrong on here, and maybe we have the wrong crowd. But I'm glad that technical analysis is 99%, Erin, because that's what I would have expected based on the crowd that will be watching our show.
Yes, I'm kind of surprised that we even have a 1% that don't.
Yeah, but it's probably rounded, so maybe it's 151 out of 152 that have responded so far.
Right.
Fundamental analysis, 50%. That's kind of an interesting number, because I would check off all four of these, by the way. Mm-hmm. Technical, fundamental, historical, and monetary. I follow them all. Monetary policy, along with, of course, earnings, helps to drive the long-term picture. I mean, monetary policy, and as a short-term trader, I'm not saying, okay, I'm not going to trade until I see what the Fed's going to do. I don't look at it like that, but it does kind of shape my big picture view on what I think, not just the fact that rates are going up, because I think everybody knows that rates have been going up, and I think they're going to continue to go up, but the reasons why rates are going up. Is it inflationary concerns? Maybe a little bit. But I think more importantly, it's about the strength of the economy and the jobs market and that sort of thing. So anyhow, which ones did you check off, Erin?
I did all four of them, just like you were saying. Cool. Mainly because I use it. I don't use all of them that much. You know what I mean? I use technical analysis 99% of the time, as it's saying there, but I do throw in, some of the earnings information. I find the seasonality useful. I consider also sector rotation as part of that historical analysis. Mm-hmm. So yeah, I use quite a few of them.
Yeah, well, I thought it would be interesting to do a segment. I mean, I've talked seasonality, and of course, we've done segments with drilling down, but I thought it would be interesting how you can use the seasonality to just kind of start filtering down into a group, because you could diversify a portfolio based on what some of the things I just went over, and have stocks in different areas that tend to perform really well, and then just make sure those technicals line up. You may want to hold off, especially on the home builders. Mm-hmm. They've been so weak, I wouldn't be rushing into any of them right now. But knowing that November and December tend to be extremely strong months, and January, by the way, I would be watching them closely for the first sign of technical strength, because we do know that, once technical outlook improves, we do know that the seasonality backs it up as we go forward. So that's kind of how I like to combine. I thought it'd be an interesting segment.
Yeah, I think it was great. We did have one question. I don't know if it's what you might think, but Tom, do you feel the election could change your theory? Like if we got a change in the House or ended up with some policy changes?
Honestly, I don't get into the politics. I think it just makes headlines. I don't get in on either side. I think that, depending on what the market's doing, it's kind of like, okay, this is why it went up because of this political deal, or right, because of that political. I mean, I think they just use it. All of that information is built into the price. I mean, if you really follow technical analysis as is, which is what we should be doing, everything's built into the price action. It's not like everybody investing has no idea what's going on in our political environment, right?
Exactly.
So It's all factored in. It's in price action. So no, I don't sit back and worry about what's going on politically. I just follow the charts, what the fundamentals, doing my earnings analysis, that sort of thing. And then throw in seasonality. I mean, I don't consider seasonality to be my number one go-to. Obviously, that's technical analysis, but seasonality can really confirm and give you a lot of confidence on trades, I believe.
Yep, absolutely. And I do agree with you. I mean, I'm almost a complete technical analysis purist. I mean, I do pay attention to those other items on that list, but not completely, because I do believe, like you're saying, that it's baked into the price. The only thing that can be sort of interesting, I would say, is, you know, those earnings surprises. But as you have shown over and over, just because it's an earnings surprise to the upside, it doesn't mean that the price of the stock is going to go up. It's because they're already thinking about the things that have been happening up until that point.
Yep. And I was just sitting here thinking I probably could have added sentiment analysis into this poll as well. But we're going to have to end this poll because I saw technical analysis just drop from 99% to 98%. So somebody else did not just voted and didn't use technical analysis. Technical analysis.
Well, maybe they're going to get sold on it if they watch our show regularly.
I hope so.
Yes. All right. Well, it is time for the 10 and 10.
Yep.
Great segment. Hope you're ready.
I am.
Got a lot of requests. I'm going to go ahead and share very quickly so you can see what I am looking at right now. And as far as our RG goes, you know, we've got all of them all over the chart. I'm looking for ones that are going in that northeast direction. I'm not picking all of them based on that, but that's one of the things Julia says we should look for interesting charts and prospective candidates. All right. What I found interesting today was looking at the sectors that healthcare made an emergence here. You know, we've been seeing some interest in healthcare, but now, definitely have expanded that, and technology and cyclicals are pretty much the typical amount that we normally get, but I thought that was interesting. So let's go ahead, Tom, grab that screen, and I believe, yes, our first one is Arista Networks.
All right, ANET, got some mixed signals here. We're coming off an uptrend, sideways consolidating, so I do expect the next move to be the upside. But during the entire period that the group, telecommunications, was sideways consolidating here, we sideways consolidated with the Arista Networks, but on the breakout in the group, all we could do was go back and test the high and then pull back again. So as the group's been going up higher on an absolute basis, unfortunately, Arista has been moving back down on a relative basis. Now, we've been down in this area multiple times. I like the group. I think the group's going higher. I wouldn't give up on ANET just yet, but I would I think I'd watch this trend line. I wouldn't want to hold it all the way back down to this support area down below 240. We have multiple tests along trend line, and trend lines, in my view, are only as strong as the number of connections that you have on it, because I can take a trend line and I can draw and connect any 2 points on a chart. So that doesn't really impress me when I see two lines being connected by a trend line. But when you have multiple tests, and here I'm talking about probably 7 or 8 different days where we have either gone just below or right down to this trend line, I think it's pretty important. And you can see over the past 5 or 6 weeks, we have not gone below that 260 area. So I think that trend line at 265, price support just above 260 is enough to that's where I would keep my stop, because you do have a stock that's not really performing well relative to its peers, but it's in a good group. So I think there's a lot of mixed signals here, but if I had to say buy or sell, I'd be a buyer of the stock with a fairly tight stop.
All right, excellent. Let's see, our most popular in the chat room based on likes by a mile really was Disney, DIS.
Yeah, Disney is one that's just being moved in the sectors. So it's going to be moved out of the consumer discretionary area. And so that's going to be kind of an interesting deal. I think Arthur wrote a Don't Ignore This Chart article about Disney recently, I think when it was down in this area, saying that this was an area where maybe we should be looking for a reversal. So I got to give him some credit. I think it was Arthur. Maybe it was Greg, but I think it was Arthur. I just want to annotate here the highlight and what he was talking about in that article. But here is the prior high, heavy volume. You pull back, and then you break out on increasing volume again. That prior price resistance, TA 101, becomes price support. So this is what the article was referring to here. We came right down to the support level. And I remember when Disney went up here, this I think was related to earnings. And it had put in that, you can kind of see that shooting star doji at the very top off an uptrend, and that marked a pretty significant short-term high. We went all the way back down and tested this support level. I think we're heading back up to not only test this 117, 118 area, I think Disney breaks out. So I like it. I think short-term you might be able to get it a little bit better price on a pullback to, say, the 20-day moving average, but I think Disney looks good.
All righty. Let's see. The next one I have for you, our only utility, AT&T. T.
All right, T has definitely been improving. I'm going to pull up on a relative chart so we can see how it's doing relative to the group, because the group has not been all that strong, and you can see AT&T has quite an influence because you can almost put these charts over top of one another. But we do have the group almost ready to break above the June high, and AT&T already has. So here's the deal. You got a pretty good, and I think this chart kind of sums up the fact that T is basically the index. But we are breaking to a little bit higher high in terms of a relative chart. The group has been moving higher. The only thing I have a problem with on AT&T is if this group starts to, if the group overall doesn't see its share of the money coming in. And when we look on a relative basis, that has been the problem. Here is the industry group relative to the S&P that continues to go down. T versus the S&P 500, even though it has kind of strengthened here in September, the overall trend has been down. So that's my problem with AT&T. I just think they're better stocks. We have seen a breakout, improving volume, so it's definitely getting better. I wouldn't invest in it simply because I think they're a better alternative. So I'm going to pass, and I didn't annotate this, so let me just put a quick annotation. One of the things I would watch for is to the downside. I think this is a support zone between 33 and 33.5 that needs to hold. If AT&T goes below it, I wouldn't hold the stock. I think there's just too many other better opportunities out there.
All right. I thought this one might be interesting. The Vectors Steel ETF, VanEck Vectors Steel ETF, SLX. Interesting consolidation there.
Yeah, and we just talked about steel being so strong on a seasonal basis in the fourth quarter. So I think I didn't check out the price of steel. Actually, maybe that would be a good thing to do. Let's check out the seasonality on the XLX. We can always come back and annotate this. Over the last 13 years, pretty decent, 4.5% average return. So I think maybe some of the steel stocks are better plays than SLX. Let me see go back and take a look at one of those. Let's take a look at the SLX versus, say, CLF. And we'll do this over the last 13 years. That was one of the steel stocks. So if you pull this back, you can see it goes along for the ride in October, but it actually underperforms by 3%. So there's probably a bit more risk in CLF because it's an individual stock. But I tend to trade individual stocks, so I would probably go with CLF rather than XLX. But if we're just talking about the chart itself, let's go ahead and pull this up. And yeah, I mean, we're breaking the down, or looks like we're breaking the downtrend. Let's do a 1-year chart here. Yeah, it's I think the technicals are beginning to improve here. I'm not ready to go crazy, but if we just kind of draw a trend line here, you can see it looks like we are breaking out of that. So what that means to me, and if we look at the PPO, which is strengthening, you see what happened here? We had PPO strengthening across the center line. We came back down. We failed to hold that rising 20-day, and that led to all sorts of problems. So I think what I would be doing is now, if this is truly an uptrend, that rising 20-day should hold. So watch that on any future weakness.
All right. Let's see. You motivated me here. I'm going to have you look at FedEx, FDX, and I just happened to look at the seasonality chart, and the next 2 months are the best months over the past 20 years.
Okay. Well, I would be looking technically. I think we've got a lot of support lined up here just over the last 7 or 8 weeks. Every time we've gone down just below 240, we've held. That's where we are right now, 240. Now, the one thing I would say technically is, and I'm going to go ahead and just save this, I believe UPS has been performing a lot better. And so that would be maybe my alternative, is that while FedEx, and maybe you can look at that one on a seasonality basis, Erin, UPS, and see if that also does well. But I think technically if we pull up UPS, well, it's pulling back too, but it had recently broken out above to like 6-month highs, and you can see FedEx had not. So,
well, it does look like it does well in October and November, but not quite as well as FedEx, really.
Okay.
November's a really good month.
All right. Well, there's a couple of different possibilities there, but FedEx, technically, I'd like to see the support level hold. This is where it's been holding for about 7 or 8 weeks. If it fails to hold here, then you're looking down at the lows that have held around 225. And as a short-term trader, I just don't like giving up that much room, so I'd keep a very close stop.
All right. Let's see the next one. Let's look at MS, Morgan Stanley. Looks like it's coming down to test some support at 47.
Yeah, I think that I said earlier, the problem with the financials historically is they don't tend to perform as well. They kind of go along for the ride. They don't perform badly in the fourth quarter, but they do tend to perform just kind of, they go along with the S&P, so no significant outperformance. I think it could be different, though, with Treasury yields rising, and I think they're going to rise in the fourth quarter. So I wouldn't be surprised to see the stock begin to outperform, but what I would look for is now that it has broken the downtrend line that I just drew there, is let's see if we can get above this top at about 50.25. We just failed there. I believe a breakout above 50 with some increasing volume would be a good step here with Morgan Stanley.
Okay, let's look at a pharmaceutical. I'm not really excited about the chart, but somebody wanted to look at Teva.
I think it's consolidating. I actually do like it off of an uptrend. I don't like it where it's sitting right now unless you're going to play that 20-day moving average as key support. But what I would be looking for here, you can see that prior high should have been support. We went a little bit below it, so I'm just going to draw this other line in here as support. Here was the resistance. So from a bigger picture, I'm looking 21 to 26. So to get in at 23.5 based on these areas doesn't make any sense. The reward to risk is 1 to 1. I might as well flip a coin and decide which way to go. But we do have some good gap support that comes in here. You see the volume picked up on the gap. We came back down and we held this level around 23, 23.25, and the 20-day moving average is 23.38. So I think if you wanted to place a short-term trade here, thinking that this is now beginning an uptrend, I would maybe have a closing stop around 23, use a target of 26, and now all of a sudden you got a 5 to 1 reward to risk, which I could deal with. But that is using the other support level. Let me get rid of these. That's using the reaction low off of the gap up as support, and also that 20-day moving average.
Okay. Let's see the next one, biotech. Looks like a wild ride for this one. CNAT, Conatus.
Yeah, this one I don't know very well. Nice volume, though, coming in on the breakout. The only thing I would say about this is obviously it's a smaller pharmaceutical. I'm not really that aware. Certainly I'm not aware of any of their fundamentals. But here you can see that going back quite a ways, this area between about $5.70 and $6 has been pretty important. And as this rising 20-day moving average moves up, you could see that coincide with that support area. So those are the two things that I would look for on the way back, is maybe a test of the support zone. And if it occurs with the 20-day moving up into that area as well, I think that would be important. So I like it, but just keep it. A position like this I would keep very small, because in an effort to manage risk, you never know when a company like this is going to come out with some kind of report on a drug that maybe failed trials, and all of a sudden you're down 30 or 40%. And if you've got a good-sized position, this can really ruin a portfolio. I know it's always nice to think, well, they're going to come out with great news, but I think you have to think about the possibility that maybe it goes the other way. So I always keep very small positions of stocks like this.
Yes, I think that's great. Just knowing that it is low price like that, I generally position size a little bit smaller when I have a lower price stock, just because you do sometimes get those wild swings.
I think April.
Add to that it being a pharmaceutical, yeah.
Yeah, look, April. I mean, the perfect example. We had beautiful volume going up in early March, straight up, very similar to what we're seeing here. And yet 1 month later, look at what happened. The stock was trading at $6 and gapped down and closed that day near $4. So it lost a third of its value in one day. So I just think you got to be careful, make sure you don't position size too big on a company like this.
Absolutely. Okay, 2 more to go. Dollar General, DG.
Yeah, I like Dollar General. The problem I see on Dollar General looks like maybe we have a negative divergence, so we might see a little bit more short-term weakness in the stock, but I think you've got great support down around 105, not only in terms of price support, but if you consider this a slight negative divergence, higher prices, lower PPO, and on that move to the upside, actually volume wasn't too bad, but we did fail to hold on to the price support area, which leads me to believe that maybe we're going to go back to this price support 50-day moving average. But if we get back down there, I think the reward to risk turns to the upside. So I like DG. The closer it gets to 105.
All right. The last one we have was the first one requested, Smart Global Holdings, Semiconductors, SGH.
Right. SGH, well, not really looking very good. I mean, a number of the semis, let's pull this one up on a relative chart, but a number of the semis have struggled. But this one continues to drift lower, even though the overall group is holding its support. Actually, it's bounced off of that support. And you can see right now we're on the verge of potentially making a breakdown here. Yeah, I mean, the recent low around 28, 28 and a half. Let's annotate, take a look. I think there are others out there that look so much better technically within this space. But there's a closing support level that's been holding. Here we could go down, maybe use as intraday, which also kind of lines up with what we saw back in the end of 2017. So I think the stock really needs to start to make a move back to the upside. But what really bothers me is that we were trending higher and we completely lost the uptrend, and we did so on very heavy volume. This looks like a stock that is just trending lower. So I don't like it because of its relative performance, and you can see that down here. Just straight down relative to its peers. Straight down relative to the S&P and even the semiconductors. And I do tend to like semiconductors going into the fourth quarter. They're not showing relative strength yet versus the S&P 500. So there's not a whole lot to like on this chart. I'd pass on it.
All right. And that completes our 10 and 10. Here are the symbols that we just went over. I will have these up in the Market Watchers Live chart list at the end of the show. Just go to the blogs page, look up the Market Watchers Live blog, and there you will find the link at the top for the Market Watchers Live chart list. You know, many people ask to see Tom's relative chart, and you can get them there and then just copy that chart style so you'll have it for yourself. All right, let's go ahead and get started on our final market update. All right. And as we can see, most of the markets we're looking at almost unchanged. A lot of activity right around yesterday's close. So we are consolidating mostly sideways, it looks like. But currently the Dow is down just a little over 2 points, and the S&P is down about 3/4 of a point. NASDAQ is higher at this moment, but only slightly. It is continuing a nice rising trend, though, that we saw start yesterday after the gap down on the open. S&P 100 is mostly unchanged as well. S&P 400 following suit. Russell 2000, like the NASDAQ, is continuing a rising trend that actually started for it about midday yesterday. TSX, big gap up on the open, but has fallen and taken back most of those gains. Currently, it is still up about 13.16. And we can see that the TNX gapped up, and it is moving and trending slightly higher, currently reading at 3.106%. UUP is down on the day, but very close to yesterday's close, currently reading 24.98. GLD is up on the day after a nice little gap up, but has been trading sideways since that time. GLD is currently reading 113.66. TLT gap down and now consolidating sideways, currently down 35 cents. USO is unchanged currently. And that concludes the final market update. Excuse me. Tom, did you have something that you'd like to add?
Yeah, I was taking a look at McDonald's. I think they had come out with they had raised their dividend recently, but just the stock. I love the volume that came in a couple of days ago. We went up and tested the support level, and when it pulls back, this is what I look for with a stock. When I believe it's trending higher, and in this case, we had the PPO coming off the center line, starting to turn right back up with that move. When you pull back, you really want to hold that rising 20-day moving average and then break out again. This is the hallmark of an uptrending stock. I think McDonald's is going to go test this 170 area, which is that June high. Perhaps we'll get a pullback at that point, but I think ultimately we're going to be looking at a stock that's going to go back and test the high from a few weeks ago, or excuse me, a few years ago. Or actually, no, that was earlier this year. I was thinking it was back a ways. But we had hit an all-time high back in January. We've been going through this sideways consolidation. I think we're starting, and even on the weekly chart, I think it really starts to show that after sideways consolidating for a while, we're beginning to build some strength here in McDonald's. So looking at the weekly chart, I think we're actually going to head back up to this 175 area and ultimately off of an uptrend. Don't be shocked if we get equal highs, get these rising lows in, maybe an ascending triangle. I believe McDonald's looks good, not only into the fourth quarter of 2018, but probably going to be a good performer in 2019 as well.
All right, excellent. And somebody had requested that for the 10 and 10, so looks like you read their mind.
Awesome.
Okay, well, let's go ahead and we'll finish up the show with correlation. I'm going to go ahead and talk to you a little bit about what correlation is. And then what I wanted to do was look at the dollar versus gold, because I think it's one of the, of course, most common correlations that we do use. But you can look up all about the correlation coefficient and also just correlation in general and how you can use it to, set up allocations in your portfolios. Because when you think about it, the correlation coefficient, correlation is all about how securities move. Do they move in the same direction? Do they move opposite of each other? Are they almost the same, correlated almost the same? So what you want to do when you're using correlation for asset allocation is you want to actually find a lot of stocks or ETFs or mutual funds that are not highly correlated and and also not necessarily highly correlated to the S&P 500. You want to have a diversity, and that's one way you can do that is having having a mix of correlation, the different correlations within your portfolio. So that's one of the things that we look at often. Right here you can see. So I wanted to go over dollar and gold, mainly because it is one of the most popular correlations we do use out there. And I think most people are familiar that the dollar and gold tend to move in an almost perfect reverse correlation, not a negative correlation. A negative correlation would mean that they travel exactly opposite of each other, as far as, if it's just simply a right now we're looking at an almost -1. So they travel opposite of each other in opposite directions. And so what we want to do is look at that correlation and see what's going on between the two of them, because it can help us try and figure out where gold might be going. And the reason there is such a tight correlation between the two, of course, is that gold is counted in dollars, and so it is subject to what happens to the dollar as far as the pricing goes for gold. So I like to watch the correlation coefficient on this, because for times like we are seeing right now, we are looking at a very negative picture for the dollar, in my opinion, based on these charts. You have a breakdown from that rising trend that we had on the dollar. We're setting up now to test some very important support. And we have a PMO that is in decline, that is confirming that decline on the dollar. And you can see the scooter is starting to lose its ground as well. So when I have a negative or bearish picture of the dollar in my head based on the chart, I need to think about the fact that, okay, well, if the dollar is weak, then I should expect gold to do well. Well, let's take a peek. So we've seen, and look at this declining trend. In fact, I'm going to annotate this for you just to make the point. Make it a really fat line here in red. So note what the price trend has been on the dollar since the beginning of September. Okay. And now we're going to go look at what's been going on with gold since September, and I'm going to annotate it in the same way. It's been pretty much sideways, right? So they haven't been traveling in a perfect reverse correlation at this point. They haven't at all. So what I'm doing, and you can look right here, you can see how they are starting to decouple, as I call it. So just now, because I'm seeing that definite weakness in the dollar on the chart, you know, I would expect to see gold to be doing well. It should be in a rising trend versus the dollar, and instead it's moving sideways. So you can see how that correlates to the correlation coefficient here, where we started to lose ground on that coefficient. So this is something that has concerned me about gold right now, because I know back at the beginning of September, you know, Greg Schnell had been talking it up. He said this is the perfect setup. Of course, all of us technicians are, you know, usually in trouble as soon as we start saying this is what's going to happen. So the expectation was to see gold, you know, break out, and we saw a little bit of a breakout from that declining trend right here. In fact, let's go ahead and annotate that as well. There we go. So you can see that gold did break out here from that declining trend, that declining tops trend line, and that was about the time that you know, Greg started to get very bullish. I was starting to get more bullish on it because I was starting to see some weakness showing up in the dollar with the PMO. And I saw the strength here with that PMO buy signal coming in. So again, my expectation was to see a rising trend given what was going on with the dollar. And we did not get that. Let's go look back at the dollar. There we go. So remember, there's that declining trend. Now, I'm going by my chart in that I'm expecting this support level not to hold on the dollar. I'm expecting the dollar to move lower. And you can see that 20 is about ready to cross below the 50-day EMA. So that, to me, is a confirming signal. If we get it, it would be an intermediate term trend model neutral. So to me, we're setting up for a fairly good decline, I would say, on the dollar. And when I look at where our next support levels are, obviously this is a pretty obvious support level here at those October, November tops. But if that does not hold, we're going to have to move down here to this level of support back here at that December top and that May top right there at about 2450. So currently my observations on this chart, I'm expecting to at least test that 2475 area. But now if that does not hold, I would start looking at that area of 2450. So I don't see things looking too good for the dollar. And when I look at the weekly chart, look at the weekly chart. We're getting that PMO is topped and it's starting to head lower toward a sell signal. These signals don't come in that often. Note right here. I'll do a vertical here and thick. So when did we get the last sell signals? Let's see, right in here, back here. You could see they tend to be, especially if they come in overbought territory, fairly accurate. This one in particular that came in at about the same level as what we're seeing here on the dollar certainly portended some very difficult corrective move. So I am looking at this and in conjunction with my daily chart here, and I am expecting some downside on the dollar. I'll give you a quick look at the monthly. Look at the monthly chart for the US dollar. This is dollar USD, not UUP. And you can see we have a top coming in under the signal line for the dollar. It is coming near some important support here at 92.50. Again, this is for dollar USD. So I'll have to see what ends up coming of that. And I'll give you just a quick another peek here at gold. And again, there's that correlation as it's decoupling. So that tells me that I don't necessarily need to expect a huge bullish outcome here on gold, because it is decoupling. And I think that is not good for gold at this point, because obviously you want to keep that reverse correlation in play if the dollar is going to start heading lower, but it's just not making the moves it needs to make. And here's the weekly chart for gold. There we go. You can see that very long-term declining tops trend line. We got the bounce off of that earlier back here in August. You can see where that came in, that tail. And it bounced back up. And now you can see it is holding on to some very important support. If we lose that support, I'd be looking for a move down to 1150 to test that declining tops trend line once again. But again, I would expect to have seen gold doing better based on what I'm seeing for the dollar. We do see that the PMO is trying to decelerate and turn back up, which is good news. And we can also see that the discounts on Sprott's Physical Gold Trust are very high right now, and that implies bearish outlook for gold, and bearish in terms of sentiment means bullish for that particular stock, and in this case gold. And one look at the monthly, and then we can close out this show. And there you go, there's that long-term declining tops trend line, and there's that bounce we got back here in 2017, and now we've come in, we had a bounce back here in 2018, and now we're testing that very important support level on gold. So let's hope it can hold it. Based on the dollar, I would expect to see gold rise, but you know, we're having some issues here. And then notice this on the monthly chart, we do have a PMO sell signal on the monthly chart. So the very long term for gold isn't necessarily rosy, but I would have to say, looking at the intermediate term and the daily chart, the expectation at this point should be a rally. And the only thing that is preventing that, in my opinion, is the fact that that correlation, that gold has been decoupling from the dollar. So that's what I wanted to talk about, correlation, with you. And here is our summary slide. And there we go. So I covered what correlation, the correlation coefficient is, and then the fact that right now on that 50-day moving average of the correlation, we are seeing the dollar decouple, or gold decouple from that dollar.
Okay, very good, Erin. I will say, too, that we do have a Fed announcement coming out tomorrow, and just about everybody's expecting another quarter-point hike. And, of course, that is one major factor in determining the, obviously, the direction of interest rates, but also can have a pretty big impact on the dollar and, therefore, on gold as well.
Yes.
So it'll be interesting to see how everybody reacts tomorrow when we get what will likely be a 25 basis point hike.
Indeed.
Okay, I want to thank everybody for joining us today. Please remember to complete that survey as you exit. We do love to get your feedback, hear what you think of Market Watchers Live. In particular, I'd like to hear what you thought of the presentation today with the seasonality and drilling down. It's the first time I think we've actually combined that. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody, and hopefully we will see you back here tomorrow. Happy trading.